Now we will spend about 15 minutes in understanding the basic intuition behind the topic. And once you understand the crux of this topic in next 15 minutes, the remaining topic is going to be a really smooth ride. So now the first thing that we appreciate is that every organization prepares two separate books of accounts. So the first book of account that they prepare, this particular book of account, in this reading, for ease of reference, we are going to call this as accounts book. This accounts book is prepared using the accounting standards, which we have already seen, for example, using the accounting standard of IFRS or US GAAP. But a firm is also simultaneously required to prepare a separate set of books. So they will prepare one more set of financials separately. This book we are going to call as the tax book, and these financial statements would be prepared as per the taxation laws. Now one might wonder that why do we need to prepare these two separate books? The reason we prepare them because these two rules, the accounting standards and the taxation laws, are different. Now the question is, why are these two set of accounting standards or taxation laws different? Because their purpose of building those accounting standards or rules is different. The purpose of these standards is to show a true and fair view of the financial affairs and financial position of the company. That means to reflect truly what is happening with the business. However, in most of the countries, the purpose of the tax book is to receive from the government perspective as much and as early, so receive taxes as much and as early as possible. Okay, so what do I mean by this? Think of a hypothetical scenario that a customer has given you order, he paid you 100,000 rupee, and those goods you are going to deliver next year. In the accounting books, what will we call that amount? Unearned revenue. We will not consider that as revenue because we haven't completed the revenue earning activity. So that 100,000 in your accounting books would be shown as a liability. It will not be considered as a revenue. Of course, we will receive cash, so that would be an asset. However, in the taxation book, in most of the countries, the tax would be charged based on cash or accrual, whichever is earlier. Which means even though you've not earned that revenue, if you've received the cash, in the taxation books you would be required to show as a revenue. And this is the reason why the two rules are separate. Two rules are separate, so we have two separate financial statements. Are we fine with this? Now in two separate financial statements, because rules are different, profit would be different. So let's say profit and profit in these books, they are different. Let us say profit here happened to be 200, but profit here happened to be 150. If profit is different, the amount of tax we will calculate is going to be different. So we have some hypothetical amount of tax. Let me say this is 60. Let me call this tax amount as 45. But which is the amount of tax we are actually going to pay? 45 or 60? 45. We will pay taxes as per the tax book. So now I want you to think of this concept as similar to prepaid expense or accrued expense. That as per my accounting books, my tax amount was how much? 60. But how much did I pay? 45. So that 15 is still pending, and that 15 would be considered as it's a liability because I'm yet to pay. So that liability would be called as deferred tax liability. But had the scenario been other way around, that instead of tax amount being 60, let us say tax amount here was 50 and tax amount here was 60. Now we've paid more, and when we pay more, you can think of that concept as prepaid asset or prepaid expense. So this, in the taxation world, we would simply call this as deferred tax asset. Okay. So simple rule of thumb going forward that we are going to use, you would ask yourself question, am I paying more or am I paying less? If I am paying more, it is a deferred tax asset. If I am paying less, it is going to be a deferred tax liability. Are we fine here? Now please write down this part quickly. Now let us build a hypothetical example to understand this concept. Let us say we have purchased a new asset. This asset is worth 100,000. Now what we have estimated that life of this asset, in fact let me not define the life right now. So let's say asset purchases 100,000. Now these are my two separate books. Let us say this is the accounting book and this is the tax book. Now in tax book, I am allowed to charge depreciation at the rate of 20% per annum on a straight line basis, which means every year the amount of depreciation would be 20,000. In case of accounting book, let us say we are allowed to charge depreciation at the rate of 50% per annum straight line method. This is year 1, year 2, year 3, year 4, year 5. Let us say a hypothetical revenue amount. Okay, this is an assumed value 1, 2, 3, 4 and 5. Every year company has been able to generate revenue of 1 lakh. Okay, 1 lakh in each of the year. And for the timing we will assume that only expense that we have is depreciation. Can you tell me what would be the depreciation in the accounting book in the first year? 50,000. So this is 0.5 lakhs. How much would be depreciation in the second year? 0.5. How much in the third year? Third year would be 0 because we have depreciated the entire amount. Fourth year, 0 again. Fifth year, 0 and 0 again. Now let us look at the depreciation in the taxation book. How much will we have in the first year? 0.2 lakhs, 0.2 lakhs, 0.2 lakhs, 0.2 lakhs and 0.2 lakhs. Because depreciation is different, your profit before tax is going to be different. So profit before tax 0.5, 0.5, 1, 1, 1. Profit before tax for each of the year would be 0.8. Now we would look at the value of tax that we have to pay. Let us assume a tax rate of 50%. So first year, here the amount of tax would be 0.25, 0.25, 0.5, 0.5, 0.5. How much would be amount of tax here? 0.4, 0.4, 0.4 and 0.4. Up to this we are fine. Now see it carefully. First year, as per my accounting book, I was supposed to pay tax of 0.25. But how much did I actually pay? 0.4. Have I paid more or less? More. So if I pay more, that would be a deferred tax asset. So first year, we will create a deferred tax asset of 0.15. Right? Because I was supposed to pay 25,000, I paid 40,000, deferred tax asset of 0.15. Next year, the story got repeated. I was supposed to pay 0.25, I have paid 0.4. Again, that extra 15 we've paid is deferred tax asset. But now this year deferred tax asset will be 0.30 because 15,000 I paid extra last year, 15,000 extra I've paid this year. Are we fine? Now see what happens next year. Next year I was supposed to pay 0.5, but I paid only 0.4. Now why am I paying less? Because in the past years I have already paid more. So this is where what we will have is reversal of DTA. Okay, how you can think of this? That you will go to the tax officer, you tell him that I have already paid more in the previous year. So this year I am going to pay 10,000 lesser. So now what will happen to your DTA? It will not remain 0.3. Now it will become 0.20. You've adjusted that previous 10,000 this year. Same story in year 4. that you were supposed to pay 0.5, you paid 0.4. Now DTA will become 0.1, and the last year DTA will become 0.0. Are we fine here?